Okay, so today I'm going to show you how to set a trailing stop to minimize your losses and maximize your profits. Okay, so on screen here I've got a chart of the US dollar against the Swiss franc. This is an hourly chart and I've set the stop loss here currently. This is not a live chart, by the way, because it's Saturday here in the UK, so this would be coming up for next week. So here I've set the stop loss at the top because I think the price is going to fall, and one of the reasons is because if we go back here, it's met some resistance here on the wick, and that's on the 14th, and we can go back even further again before the price has actually hit that. So you go a long way back, and I've done some other analysis as well, so I think it's going to fall. Okay, so let's get on to the main aspect of this clip, and that's to show you how to set the trailing stop. Okay, so to set the trailing stop, this is in IG index, by the way, but other brokers will have facilities where you can obviously set a trailing stop, and I suspect it's pretty similar on most brokers. So on IG, you click there because I'm going to be selling. Okay, I've got £5 per pip, and at the moment the stop is normal here. So if I put, for example, a figure in here of, let's put 15. Okay, remember this isn't a live chart at the moment. Okay, so I've got a limit of 30, so I'm looking to get 30 pips at the marketplace. Okay, so up here is my stop, and it says there risking 15 pips, that's £75, to gain 30 pips, and that's £150. So it's a return of 1 to 2, which is very good. Now, to set a trailing stop, all you do is click on the stop where it says normal, and you've got a choice of guaranteed or trailing. So we click on the trailing. Now, what comes here is what's known as a trailing step. And this is how many pips you want the market to move before your stop actually moves. So in here, for example, it says you've got to have a minimum 1. I'm going to put 5. And obviously, this comes with experience and, just trial and error, really, just to see which distance is ideal for the particular marketplace you're working in. But I've set this for 5, for example, just to make it easy to understand. Okay, now you won't see anything different on the screen as such, because obviously it's a trailing stop, and it only moves obviously when the market's live and if it moves in the right direction. But let's look at what can happen. Okay, so we're starting up here, and I'm hoping for the price to fall down. And I'm looking to get here to the limit here where the arrow is. Okay, so that's approximately 30 pips. Okay, it's 9057.8. Okay, now say if it doesn't quite hit that point. So say, for example, if it hits here where the arrow is, okay, and that's at 9060. So I've just missed out and hit my limit. Okay, and say I've got a normal stop in. Now if this price continues to go all the way back up, which it very well could, especially goes up there and hits the stop, then I've lost my 15 pips, my £75. Okay, but what happens is, because the market's moved down so far, my stop here, my stop trailing stop now, has literally done as it said. It's trailed the price, and now it's come down to this blue line here. So as the price has gone up there 960, the stop is now 9075. Still the same 15 pips away, but obviously I've tied in some profit now. So I've actually made some money, and that's actually 12.8 pips away. Bear in mind you've got to pay the spread as well. So it's 12.8 pips away. Okay, multiply that by £5 a pip, and you're looking at £64. Okay, now you might say, okay, but what if it goes up and comes back down again? Which obviously it could go back up, and it could come back down again and hit your limit. I mean, obviously that's a chance you have to take, but again, you don't know, it could just carry on all the way up. So there are two ways of doing this. I mean, basically you go for boom or bust. You either go for strictly the 2-to-1, the limit. You're quite happy to risk the 15 pips, the £75, or you hedge your bets and you want to get something out of the marketplace. Obviously there are pros and cons of the trailing stop. If it is too close, if your stop is too close to the price, then you get risked being stopped out. If it's too far away, then you're going to get losses that you could have avoided. So those are the ways you can do it. You can either have a trailing stop or a normal stop. As I said, a trailing stop, you're always going to take some money out of the marketplace. For example, a trading stop, if you're doing swing trading on a longer time frame, then the market can move a hell of a lot of distance. And if it moves that far, it can also move back as well. So you could have this long stretch of potential profits and then see it all dashed away because you refuse to move your stop. I mean, you can move your stop manually, but then obviously then come the emotions of moving a stop, which you should never do. I mean, you should never move it manually, because then you're letting emotions coming into it. You're thinking, oh, the price is going this way, going that way. And as we all know, price does fluctuate. The market breathes in and breathes out. And you've always got to leave some sort of gap. And if you're just reacting to the way the price goes, then you're letting emotions come into trading. This way, you can just set your limit, have your trailing stop. I mean, the good thing about setting this is, yes, you could normally set your limit and set your stop. And you're thinking, well, okay, bank on the fact that it's going to lose. I'm going to lose my 15 pips, £75, and then come back or set it on alert and see what happens afterwards. But if you have a trailing stop, at least if it goes, into profits, then you're going to make some kind of profit. Once it gets to once your stop moves up to break even, then you're in the trade for nothing, basically. And if it does move into profits, okay, you might not get the max amount of profits, but you can never predict exactly the top of the market and the bottom of the market. You never predict exactly. You're never going to get the full chunk of the price movement. So it's better to get something out of the pie than nothing whatsoever. And this isn't a recommendation. This is just my opinion, and it's a lot of trial and error, especially with obviously deciding how much you want the trailing step to be, and it will depend on different marketplaces as well. But I feel this is a good method if you want to guarantee that at least you're making some money. It's better to make some money than no money and cut down on your losses, which will improve your overall balance sheet. So this is a trade coming up for next week, and if I take the trade, which there's a great possibility I'm looking into it that I probably will, then I'll definitely be using a trailing stop, and hopefully if I don't get my limit price, at least I'll get something out of the market. And never say no to a profit, never say no to a win. So that's what I'm hoping will come up next week. And yeah, that's how I see trailing stops, and I think they can be a very useful tool to at least getting something out of the marketplace. Okie doke. All right, I'll see you. Thanks so much. Cheers.